If you're in real estate, you're going to want to hear this. I've been doing this a long time. This is my prediction for 2024. Interest rates are going to come down maybe a couple of points, maybe under 6. And because we've got such little supply, pricing is going to skyrocket in 2024. Let's get into it. Here we go.
You're listening to Seattle Real Estate Podcast.
So we've already got predictions being made that the Fed will shift to full-on accommodation mode in 2024 with nearly 3 percentage points of rate cuts as economy slows, UBS says. UBS being a big investment firm out of Switzerland, I think, they're basically saying, hey, this is what we are predicting for 2024. Maybe a little bit of a rate cut in March of 2024, but up to 2.75% 275 basis points in 2024. Let's read the article. And I'll explain what I'm thinking as we go. Federal Reserve will shock markets with aggressive interest rate cuts next year, UBS says. UBS said slow economic growth would drive the Fed to cut rates by 275 basis points by the end of 2024. We expect substantially slower growth in 2024. So growth slowing down, which is what the Fed is trying to accomplish. The Fed's trying to get inflation down to a dose percentage points basis, right? What was it when Trump was in office? Like 1.8? Oh, yeah. Well, anywho, so we expect substantially slower growth in 2024, a rising unemployment rate, that going up, and meaningful reductions in the federal funds rate. Meaningful reductions. We're not talking about half a point. We're not talking about 1 point total over the course of XYZ. We're not talking about quarter point, monkeying with the interest rates. Talking about substantial, meaning one, half, quarter, something like that. Substantial. And that would be substantial. And then mortgage rates will follow. They will follow. To what extent? I don't know. Between 5 and 6, total guess. If we had between 5 and 6, what's going to happen is you've got a ton of buyers out there who are wanting to buy, but they're just saying the pricing, because pricing has not come down. Pricing here in King County has, in many communities, it's gone up. It's been going up. It hasn't dropped down. And that is because even with interest rates between 7.5% and 8%, there's enough people still buying, and there's so little inventory because sellers, if they sell their home with what they might have a really low interest rate or no interest rate, no mortgage. Sellers have to move on to the next thing. And in today's interest rate climate right now, sellers are saying, no go, not going anywhere. I'm going to sit on this. But you get a 2-point reduction in interest rates, maybe a 2.5%. reduction in mortgage interest rates, you could be off to the races again. The issue is there's no supply in the marketplace already. So you add that fire of demand with these interest rates coming down, which big entities are predicting will happen. I'm not just throwing this out there. I'm not just grabbing it out of my backside saying, that's what I think will happen based on my 30 plus years in real estate. Don't you hate it when people say that? Yeah, don't care. Show me the evidence for what you're talking about and I'll believe you. But this whole, I've been doing this for whatever years. It's just a bunch of nonsense. Show me what you know and prove it to me and I'll believe it. So here we go. But getting back to if you've got a situation where you've got very constricted supply, which is what you have already, and that is what has kept values propped up. And in many communities across the United States, same thing, because sellers are in the same market. They don't want to sell and have to take on an 8% interest rate when they've already got one at 3, 4, 5, even 6, because that bump up is so substantial payment wise that it doesn't make sense. So you got a whole bunch of sellers hanging on. You got a whole bunch of buyers saying, we can't afford an 8% mortgage rate, but we could figure out a way to make it happen at 6, 5.5. You betcha. which are high rates relative to where we were during the pandemic. But that was an artificially low environment, right? That was just a freak show with the interest rates and a freak show with real estate. But you add that little bit of demand in there and you've got no supply. You're going to strip out that supply and just boom, pressure goes. Prices go up. The Federal Reserve is going to shock investors next year by aggressively cutting interest rates amid a slowing economy. This always happens, right? I shouldn't say always, but this happens more often than not. Oh, the Fed kind of takes a little kickback and goes, oh, yeah, we may have overshot our target a little bit here. And you know what? With the upcoming elections in 2024, maybe we need to stimulate the economy just a scooch because we constricted it too hard with our aggressive pricing with rates. They bumped rates up how many times? A bunch. If you're in real estate, you understand how much this has impacted you because the real estate market has been the number one market to be impacted because we're so interest rate sensitive. Other businesses borrowing in this market, yeah, they're impacted as well. But real estate across the board has just been shellacked. The firm said in its 2024 economic outlook, it expected economic growth to slow considerably next year after this year's brisk pace of growth. So the Fed has been raising those rates, trying to get that inflation down, and it's just been stubborn, hasn't it? Well, that's what happens when you send trillions and trillions of dollars through the economy. And then you have the Inflation Reduction Act. Oh, faux pas there. Nah, it's produced inflation, hasn't it? Dump a bunch of money into the economy. That's going to happen. This is not that hard to figure out. So we've got lead to reduced retail spending. I think you will see wildly reduced retail spending this holiday season. I think you will see those numbers. That'll be one more thing that the Fed will have in their quiver of, and I say quiver because they're shooting arrows, trying to figure out, all right, we're going to monkey with the interest rate, the federal funds rate, other rates will follow. We'll see if that has an impact on the economy. Well, I think it's having more of an impact on the economy than the numbers are showing right now. And that happens as well. You get these revised numbers. It wasn't bad. It was really bad. So we've got reduced retail spending. That's what they're predicting. A worsening consumer balance sheet. People putting more stuff on credit cards. Yeah, doing that. Their savings being depleted. That's their balance sheet, right? Buying fewer cars, buying fewer newer cars. We know they're buying fewer electric cars because production of electric cars is kind of peaked, right? We just don't have the ability to, make all those batteries go and charge them up. Electric cars are making about 1% of the market. Yeah, well, everybody get an electric car though. And a continued rise in the unemployment rate. That is the one thing that a lot of folks are saying. Focus on the unemployment rate and the rest will follow. All right, well, keep that in mind. We expect economic growth to slow sharply in the next few quarters, with a mild contraction worth 0.5 percentage point in the middle of the year. All right, so by, call it June, 0.5 point, they're really just, all right, we're lining up this, and this, and we're saying this is going to happen. You could have some major events happen before that would impact this wildly. But given the circumstances and given the information we have right now, I believe this is a pretty viable situation. And you know what also happened is the industry is getting rid of jobs, getting rid of mortgage jobs, getting rid of escrow jobs, getting rid of title. Anybody, appraisals are way, way down. This has been the sharpest contraction of appraisal volume I have ever seen. And I've been part of Reynolds and Klein appraisal, which was Reynolds and Associates, since literally the mid 1980s. A very long time. Seen some big booms and I've seen some massive drops. This one has been the biggest drop ever. I've talked with other guys in Capital and they've said the same thing. This is a wally banger because of literally shuffled trillions of dollars through the economy. Economy took off, rocketed, and housing was already going before we had the pandemic. Housing was cruising along. We had these low interest rates. We had low inflation. We had, real estate market that was really strong. And then we just jumped the fire on it of bringing those interest rates down because nobody knew what was going to happen during the pandemic when you shut the economy down. Yeah. Well, now we're figuring it out. And we've got inflation, super high interest rates relative to where we've been. Not historically. Rates are still great. If you're in single digit interest rates, historically, that is not a bad situation to be in. Meanwhile, UBS said it expected the unemployment rate to rise more than a full percentage point from current levels to 5% at the end of next year by 2024. By March, it said, this is March of 2024, the Fed will start to slightly tweak rates lower. So quarter one in 2024, the signals are there for rate reduction. And we've still got this wildly inadequate supply of housing. And what I'm going to go back to is you've got this contraction of jobs in the real estate industry. So the market will get caught flat-footed. You won't have enough appraisers. You won't have enough people in escrow. You won't have enough people in mortgage. You'll still have a number of real estate brokers because there's always real estate brokers out there, right? But the other more paid positions, not necessarily 100% commission, you won't have enough folks because everybody's given up all of those paid positions because they can't afford them right now because that's overhead that they can't have given that there's very little volume out there. Just, it's not happening. So all of a sudden you're going to have this burst of activity. You're not going to have enough people to deal with it. And the supply and demand and supply equation is going to be wacky because it's already wacky. And you're going to see those prices go one way and it's not down. Remember during the pandemic, everybody was like, oh, prices are going to fall. They're going to come on down. They have to, right? Because we're in the midst of a pandemic. Well, look at your supply factor. Yeah. And then everybody was like, all right, if I'm going to have to hunker down for a couple of years in this house with Junior and Junior over there homeschooling, the wife is right there next to me working, got the dog, can't go anywhere. There's no restaurants open. We need a bigger house. And so they did. And at those super ridiculously low interest rates, we had so many sales transactions get compacted. So like we had maybe 10 years with the sales transactions get compacted into a couple year period because people are like, all right, yep, I'm making that move up. All right. Hey, it's super cheap. Rates are so low. Maybe I take that next step and just call it good. Stretch myself a little bit to get into that next tier after making one tier already. And that's what you've got. And so some of that is also impacting today's real estate market from the standpoint, you've got sellers that might have bitten off a little bit too much than they could chew, but they made the decision based on these really low interest rates. And now they don't want to go anywhere. They don't want to sell. So here we sit. However, as the slowdown in the economy and the extra disinflationary leg begin in earnest, we expect the Fed in the second half of the year to turn to full-on accommodation with more rate reductions in line with what it has done historically. All right, so they're saying, hey, we've got precedent for this. And based on the data out in front of us, this is what we think happens. Could this happen sooner? Well, I mean, we're already in November. I'm recording this for you on November the 14th. We're mid-November. Don't have enough time to get the data out by the end of 2024, right? Quarter four is basically done. You got the holidays coming up. That is always historically a slow time for real estate. It's a good time. It's the time for retail. And that's where I think the retail numbers, people shopping, going to the mall, buying stuff, eating out for Christmas, doing the holiday celebrations before they look at their consumer balance sheet and they look at their credit card and go, holy smokes, I spent that much over the holiday season. Cinch up that belt. Quarter one. Ugh, yeah, not good. So things always kind of fall off the cart falls off the way, whatever that saying is, right? Things slow down in January, February. February is a terrible, terrible month for anything to do with consumerism because people consumed, right? So UBS said it expected the Fed to cut rates by 275 basis points, leaving the effective federal rate funds at 2.5 to 2.75. The Fed currently has rates set at 5.25 to 5.5. So that drop right there by the Fed, that is not mortgage rates. That is not consumer rates, but other rates, consumer rates, tend to follow this because this is the federal funds rate, what they charge each other, the banks charge each other. And then that effectively kind of drives our consumer rates, mainly being mortgage rates because we're in real estate and that's what we care about. Auto rates, don't really care. Yeah, it's cars. Who cares about that? Until you need a car, right? So that's well ahead of market expectations indicated by data from the CME Fed Watch tool, which expects just 75 basis points of cuts in 2024 that will send the Fed funds rate to 4.5 to 4.75%. So what I'm reading for you today is a best case scenario, more than likely. You could have something like the 4.5 to 4.75%. But I think the rebound when we see some of these inflationary numbers start to come down, I think we'll have more than a 75 basis points or 0.75 of a percentage point, cut, something like that. I think we'll have more than that. How much? Who knows, right? Because who would have predicted with the pandemic that the real estate market would just absolutely take off? We'd, have this flying start and just go nuts. Meanwhile, you can't go to a restaurant. Did that make any sense at all? Yeah, didn't for me either. But, whatever. Driving UBS's sharp estimate for a reduction in interest rates is their expectation that disinflation will continue throughout 2024, giving the Fed confidence that inflation has been tamed amid slowing economic growth. Inflation has been, it's just been there. It's just been grinding away, right? And everybody's like, God, you already jacked up the Fed rate. And it's not having that much of an impact. I think it is. I think it's just taking time to get there. And what we're saying is in 2024, we get there. So in real estate right now, you're hearing the mantra of survive till 25. Well, I think that might come a little bit earlier, but Q4 of 2023, bloodbath. Q1 of 2024, maybe we start getting going a little bit. But, we've got that spring season starting to happen, right? Seems like it happens earlier and earlier every year. Last year, we didn't, here in the Pacific Northwest, we didn't have much of a slowdown because, it was interest rate driven. And we were like off to the races the first week of January in, what was that, 2021? It was crazy. Like there was no holiday seasonal slowdown because everybody was like, all right, if I'm going to hunker down with all those people I talked about earlier, and I'm going to have to work out and work and everything else, can't go to church, whatever it is that you do outside of the home, we need a bigger house. Got to have a bigger house. And who doesn't want a bigger house when you're, forced to, be with all those other people and all that stuff. UBS said that it expected the Fed to get serious about cutting interest rates in 2024 and that a lack of fiscal policy support from Washington, D.C. would drive the Fed to move forward with the interest rate cuts. Interesting. Lack of fiscal policy support from Washington, D.C. Not shocking, right? The historically wide budget deficit, a coming presidential election. So budget deficit, coming presidential election, and a fractured political landscape to us implies little room for cyclical fiscal support, UBS explained. So the Fed is going to feel like they have to be the one to dictate the terms. They have to be the ones to do something. And what they're thinking is that it's going to be more than a 0.75 point bump downward. Shouldn't have said bump. It's going to be more than a 75 basis point reduction is what we're looking at. So is it going to be as much as 275 basis point drop? Who knows? But I think that is more likely than something smaller. I think that will happen. And I think as given exactly what we've got going on right now, I don't see any way that this goes anywhere with pricing but up, because we're already having pricing inch up incrementally. You've got some areas like city of Seattle because of some of the stuff that's gone on politically there. In my opinion, things haven't gone the way that they should have. So Seattle proper has dropped a little bit, but it hasn't had a huge drop. And there's plenty of areas just outside of Seattle that have done very well percentage-wise and have increased percentage-wise in spite of the interest rates that we're seeing. So when you see those interest rates drop, got a bunch of people jump in. There's one way for the pricing to go, and it is up. That's what I think will happen. That's why I think 2024, you're going to see a big spike in pricing. You'll see some more activity. So if you can survive till 25 or maybe a little bit sooner, that's where you need to be. All right. That's it for me on this one. Thanks so much for being here. I will catch up with you on the next one. Bye for now.